Hello everyone and welcome to today's VISTAGE webinar. Before we begin, I'd like to go over some items to help you participate in today's webinar. If you're experiencing technical difficulties joining the webinar session, please dial support at 888-259-8414. When you join today's webinar, you selected to join either by phone call or computer audio. If for any reason you'd like to change your selection, you can do so by accessing your audio pane in your control panel. During the presentation, all participants will be in listen-only mode. You're invited to submit a question through the question pane in the control panel. A recording of this presentation will be sent to attendees via email in 24 hours. I would now like to introduce the moderator for today's webinar, Joe Galvin.
Hi, I'm Joe Galvin, Chief Research Officer at VISTAGE Worldwide, and I'm happy to be here today to host the latest webinar in our Leading in Challenging Times series. This series provides the definitive source of thought leadership on pressing topics facing small and mid-sized businesses. Combining expert speakers like we have today with the peer perspectives from your group are how leaders learn and how we help VISTAGE members make critical decisions that drive growth. Today, we are so fortunate to have three of the very best from UBS to share their insights with us. Starting out today is going to be James Jack, head of business owner segment for UBS Wealth Management Americas. He's going to focus on one of the hottest topics for VISTAGE members, the payroll protection plan and the just signed forgiveness provisions of the Flexibility Act. Next, we're going to go to Brad Dillon, UBS Executive Director and Senior Wealth Strategist, who will review planning and the CARES Act, looking at some of the key tax benefits that we all should be considering and the implications on long-range planning. And before we close with all of your PPP specific questions, UBS Senior Economist for the Americas, Dr. Brian Rose, will join us to provide a brief overview of their perspective on the economy. Like I said, we'll take all your PPP questions after Brian. We've collected many coming in. We'll look forward to your questions that you bring in during live. You can also download and follow today's presentation under the Handouts tab. And tomorrow you'll receive an email with today's recording and presentation. James, it's great to have you back with us. Let's get started.
Thank you, Joe. Thanks for having me. Thanks for having me back again for my partners at VISTAGE. So, Joe, would you like me just to get in, or do you have any starting questions? I'm happy to just go right into it.
Go through. I think there's a lot of the energy, James, has been coming from not the fact that people got into it, but now how do they account for the forgiveness? And now the new provisions of the Flexibility Act has generated just a whole slew of questions. So your timing is perfect to be with us today. So just why don't you roll through your stuff and we'll process questions at the end.
Absolutely, that's perfect. Okay, thank you. Well, first of all, just besides thank you to everyone who's joined, I sincerely hope you and your families, your employees, your partners, your customers are doing well. It's a broad scope, but particularly you and your families. And all of us, from UBS Wealth Management, thank you so very much for your time. Like Joe said, I head up our business owner client segment. So my focus is really on supporting clients like all of you on right now, working, whether owners or operators, and the people who support them. So we've been doing a lot of work on PPP and understanding it. And so I want to get through, what's going on. There's one thing that is constant in this program is the ever evolving nature of it. Literally, the Paycheck Protection Flexibility Act, which was signed last week, lasted about 3 days before there was another change, which was on Monday. So timing is great because without that announcement on Monday, I would have had a very different message for you. So let me go through a little bit. I'm going to start with the Flexibility Act and what's changed from that standpoint, and then we could spend a little bit more time on some of the forgiveness rules, and then we might leave a little bit more for the end. And the reason why I'm going to do that is because the forgiveness rules that were documented in late May, I think a lot of it's going to change because of this. And the SBA and Treasury have indicated that they're going to need some time. They'll quickly get results out to us about what's changing. We'll see about how quick that is. They were 3 weeks late on the original forgiveness rules, but we'll see. So let me tell you what's the deal about the Flexibility Act. It's about 2 pages in length. It's nice and sweet and simple, and it was overwhelmingly approved bipartisan, 417-1 in the House, unanimous in the Senate. So strong support. And here's the deal. So the first thing you need to know is you'll get more time for the period, for the covered period. So as you all know, you have an 8-week period. One of the questions that was sent in is when exactly does this the period start? And it's the day you get the money in your bank account, when it's dispersed. So that 8-week period is now 24 weeks or 12/31/2020, whatever is earlier. So that's the first thing that's done is they've changed that. They've given you more time. What does that mean though specifically is it's still 2.5 months of payroll is your loan amount. So the key thing here is now instead of trying to cram, about 9 weeks of payroll that was based on a full economy and full payroll amount into 8 weeks with less people, you now have a lot more time to spend this money. That's the first one, 24 weeks. Key thing though is I know a lot of people are probably saying, I've gone this whole process and I'm in my 8th week right now, and extending to 24 weeks doesn't really help me because I've already spent all the money and done everything. Good news for you is you get to elect to keep the 8-week period. How that will actually be done to be determined, but you get the chance to keep your 8 weeks. And just a very quick side note is if you haven't applied for the PPP loan because you thought maybe you would be deemed not be taking this in good faith, or you just weren't clear about the economy, you have until the end of this month to get this loan approved. So I would, if you haven't, I would apply to a lender as soon as possible because you want to build in some time. It's unclear if it's applied by or approved by June 30th, and so I would just give yourself the time, particularly now that we have more information. So that's first one, is more time, 8 weeks to 24 weeks. Key part about that is it's 8 or 24 as it stands right now. So it's not like you can say 10, 15, 20. It's either one. And the catch on this that is important for all of you is if you do decide to go to the 24 weeks, actually, let me take a step back. The only people who get the 8-week period are people who were approved before June 5th. It's a small caveat, but just want to make sure that's clear. After June 5th, you don't get a choice. But if you do decide to go 24 weeks, the flip of that is you need to now maintain payroll for 16 more weeks. You have to maintain it through the end of the year. You have to maintain salaries to the end of the year. You're opening yourself up to uncertainty. So that's the catch. So it could be good, but it may also not be so great. It is a long period of time in this uncertainty. So that's part one. Part two, there's changes to the cost ratio, how the calculation is done, what they call the FTE reduction quotient. So so the first thing is maybe before I get to that part is how much are you spending on payroll was a big part of that. So before it was 75% of whatever you were asking to be forgiven had to be for payroll. They've changed that now to make it 60%. So this will allow for 40% of your cost to be spent on rent, utilities, and mortgage interest. So that's a nice win. And since I'm talking about rent, I want to make a mention here is that rent in the forgiveness rules that they came out with a few weeks ago, they've expanded the definition of that to be rent or lease of real or personal property. So vehicle leases, equipment rentals, those seem like they will be included. However, they need to be in the name of the business, and they need to have been a contract in place before February 15th. But that expands even further than just rent on your office space. So that's good news. So again, 75% to 60%. Here's the catch though, and this is what they changed on Monday, is as the act is currently written, it actually says for you to get any forgiveness, you need to do at least 60% based on the loan amount, not on what you spent. And if you don't do it, then you get no forgiveness. So that's kind of concerning. But Treasury indicated on Monday on their press release is that they are interpreting the rule as how they were delivering the previous 75% rule. So this is very good. This was a big open question that I had last week. So again, what that means is Now you just need to spend 60% on payroll of whatever you're asking to be forgiven. And then you could spend 40% on other things. And then plus the fact that you now have 24 weeks to do it, I think there's a very good chance that overwhelmingly people will get these loans forgiven. So that's big news there. And then one thing that's related to this, and it's actually a question I think I saw a few times in the pre-questions, is hazard pay and bonuses. A lot of business owners were moving bonuses up or paying hazard pay or were making a retirement contribution outside of their normal course of business to get to the 75% limit within the 8 weeks. If you've already done that, good news is you should be fine. The government did indicate that those costs do count. Hazard pay and bonuses, though, do count as salary. So they are subject to the same $100,000 annualized rate. So if someone makes $95,000 a year annualized, and you gave them more than a $5,000 bonus prorated for the period, which is now 24 weeks, so $2,500, effectively anything above that 25, would not count. So you're limited on the $100,000 on total salary when you include hazard pay and bonuses. That goes with wages and commission. So you can do that though. So that's also really good news. Moving on. So just because given we got some short time here, additional exceptions. So I mentioned the full-time equivalent reduction quotient. So if you've been paying attention on the forgiveness rules, how they originally set it was actually, maybe we can skip 2 slides real quick, Chris, if you wouldn't mind. How the original forgiveness rules were set was it's the smallest number of these 3, which is PPP principal amount, your loan, now your payroll cost divided by 0.6, or this other equation, which is however much you spent on allowable costs minus any reductions due to wage reductions times this FTE reduction quotient. And the reduction quotient is calculated based on the average number of full-time equivalents you have during the covered period, which again is now 24 weeks, as your numerator, divided by the average number of full-time equivalents during a baseline. So Chris, we can go back to the front. So that calculation, if I use a very quick example that said, let's say you had 10 employees a year ago, just for sake of simplicity, and you let go 2 of those people, you're now at 8. What they say is if you had that reduction in workforce and you reduce those workforce people in salary or otherwise by end of April, you have to bring them all back by the end of the year now. It was originally June 30th. And so if it's all or nothing on that, so you have to bring all 2 of them back, but they've given some exceptions. So if you can't rehire 2 people, it doesn't have to be the exact same 2 people either, just two new people. If you can't hire someone back, you have some exceptions that won't count against you. So if that person has been offered a job, but they've refused to take it in writing, and you've informed the state unemployment office, if they've been fired for cause, if they've quit voluntarily, or they've asked for a reduction in hours voluntarily. So those were 4 exceptions that can help get your number back. But in addition to that, there are 2 more were added in this law, which are that if a borrower can demonstrate an inability to rehire someone of similar qualifications, that you just can't find someone, if you can document that and evidence that, that reduced workforce won't count against you. And then this last one here, which I've quoted, is if you can, quote, demonstrate an inability to return to the same level of business activity compared to before February 15th. What does that mean? Great question. We have no idea. It's going to be subject to a lot of interpretation, and we'll be closely monitoring it. Does it mean 5% down? Does it mean 50%? Does it mean something else entirely? We don't know yet, but at least they're trying to make it so that if you can show you've been really impacted, they're going to help you get more of this loan forgiven. I'm going to go to the bottom one real quick, just because you can read some of these other things. Is this one's important to every business owner right now. And I might be stealing a little bit of Brad's thunder, so I apologize. But the deferment of employer payroll taxes originally was written as, if you got the PPP loan forgiven, you can't take advantage of deferring your payroll taxes into 2021 and 2022. Then it was changed to, actually you can up until the point you get the loan forgiven. So, maybe you get 4 to 6 months or something like that of payroll tax deferral. Now what you get is everybody, no matter what, PPP loan forgiven, whatever, doesn't matter. You can defer your payroll taxes through the end of this year into next year and the year after. And so if you haven't done that, if you haven't spoken with your finance team, your outside accountant, your payroll provider, you should really do that now. So those are some key things. Let me quickly, let's go to the next slide. I'll wrap up here before turning over, and then we can open up to questions later. But what's still relevant on this is, I mentioned the rent, and I mentioned the hazard pay, as well as the full-time equivalent reductions. Here's another important one, is on the salary reduction. If you're reducing someone by more than 25%, critical one here is, if you have an hourly employee, that 25% calculation only counts on their hourly wage, not on a reduction of hours. And the reason why is because that would double count someone. If you count them on both, then they're going to hit you on the FTE portion, because a reduction in hours, someone will go from being a full-time equivalent to a part-time equivalent or a fraction. And so how that's calculated is, a full-time equivalent is someone who works 40 hours a week. And what you do is you take the number of hours they work each week and you divide it by 40, and you round to the nearest 10th. So really, I guess 38 hours, 37 hours can probably get you to a full-time equivalent of 1. If you work 50 hours a week, you're still just 1. You don't get to count as extra. If you're below that, then it's just, you get 2 choices. So let's say you work 30 hours a week. That person, 30 divided by 40 is 0.75, which would round to 0.8. So that would be a 0.8 of a full-time equivalent. If you bring that person down from 30 hours a week, let's say, pre-COVID, and you brought them down to 10 hours a week, that could be a really serious impact to your full-time equivalent reduction quotient. The government has offered an option where you can do that straight division, or what they call a simplified method, where you take any part-time equivalent and make them 0.5 of a full-time equivalent. So for those people who maybe were 0.3 and now are, we're 0.8 of a full-time equivalent a year ago and now are 0.2 of a full-time equivalent now, it may behoove you to do the simplified method where they'd be 0.5 and 0.5, and you would show no reduction on the full-time equivalent calculation. So that's just a tip on that. You should work with your team and really think that through on what method works. You have to pick one or the other. You can't pick one for one person and one for another, though. You have to be consistent. And the key part here is, on the people who are hourly, it's only their wage that matters. So if you keep them the same wage, you're not going to get double dinged on the 25% reduction. So those are the key things. I want to be conscious of time. I know hopefully I answered a few of the questions that came in about how to calculate full-time equivalents and hazard pay and bonuses and things like that. Also, it's either 8 weeks or 24 weeks, not anything in between as we stand right now. And it has been reduced to 60% from 75%, and rent has been increased. There's a thing here about prepayments. I think some of that will change now that you have 24 weeks. But they were trying to make it so that your 8 weeks would expand a little bit. But now with the 24 weeks, I expect that the government will reduce that area of flexibility. So one last thing here before I turn it back to Joe is, there's a bunch of scenarios that are on here. Chris, maybe you could just quickly go through the slides.
Yeah.
And really read them. They're illustrative. They get complex as we talk about reduction in workforce and bringing people back, and reduction in salaries. I tried to document it and keep it as simple as possible, although that's not as difficult. Hopefully when you got some time on your hands, feel free to read through them. And of course, if you ask a question to Joe or his team, I'm happy to respond to questions afterwards.
James, thank you so much. There has been just a flurry of questions, a lot of which you've asked. And again, I would to our members, to those listening, I would say, one, always talk to your individual tax advisor and the banker you got the loan from. Because as James said, these rules are continuing to change and evolve. They're clearly making more sense, but there's more sense that needs to be made. So always stay tight to the banker you got the loan from, because they're going to arbitrate things. I'd also say we maintain a rolling list of assets like the amazing James Jack on funding. If you go to the Coronavirus Resource Center at the Research Center, you'll get to that and you'll see just a running list of stuff that we compile as this thing continues to change. So James, we're going to bring you back at the end. In the background, we're processing and putting all these questions together so we can answer those that will address the most issues. So thank you very much. Let's turn our attention now to Brad Dillon. Brad, we are excited to hear what you have to say. It's going to build really well on what James said about PPP. So I'll turn it over to you now and share with us on the planning and the CARES Act, please.
Thanks, Joe. Yeah, you're teeing me up really well when you said to talk to your individual tax advisors, because I have two things to say today. And the first thing, my mantra here, is to talk to your accountant. There are a ton of changes in the CARES Act that apply to really complex tax rules. And I've listed some of those. The get your basic affairs in order, I'll cover on the next slide. But some of these changes are meant to provide and push additional liquidity into the hands of you guys, of business owners right now. And so I'll cover those really briefly. And then a lot of these things are also going to change your business's financial planning going forward in the short term and the medium term. I would say for the next few years, actually, because as we'll see, a lot of these this year, if you have a lot of losses this year, you're going to be able to apply them for future years for a long time from now. And the second thing I'll talk about is estate planning. I'm an estate planning lawyer practitioner by background. I've practiced for several years at major law firms here in the city, and now I work here in the advanced planning group at UBS. And while the CARES Act didn't actually change anything regarding estate planning or gift and estate tax laws, the environment right now, particularly for business owners, it's never been better. And I've been saying this and touting this for the last few months. And for any of those who've heard it, especially James Jack, there's never been a better time in modern history to do estate planning. So I want to focus on that. But quickly, I'll talk about some of these tax law changes. The first one is the employee retention credit. And with that, it's probably the largest tax change in the CARES Act. It doesn't even matter if you were the 500 employees, the PPP program, you put that aside for a minute, because this is for people who didn't apply for the PPP loans. So the credit's available to your business if it has closed or partially closed or experienced a significant revenue loss as a result of COVID-19. The credit is $5,000 per employee. So what's an eligible employee? So if your business has fewer than 100 employees, they're all eligible. You don't even have to prove they're eligible. That's a potentially $500,000 credit that the government wants to put in your hands right now if you didn't do the PPP loan and if you have 100 or fewer employees. If your business has more than 100 employees, all full-time employees getting paid or not getting paid because of full or partial shutdown due to COVID-19 are eligible, which could make the credit extremely valuable, potentially worth many millions of dollars. So again, this is something I'm telling people talk to their accountant about today, because it's sort of a crucial thing to, if you haven't taken a PPP loan, this is an opportunity right here to push additional liquidity funds into your business's hands right now. The next thing I'll cover is the net operating losses. Again, this isn't something that matters if you apply. This isn't one that if you applied for the PPP loans or not, if you have fewer or more than 100 and 500 employees, it doesn't matter. This is for all available businesses, whether you were affected by COVID-19 or not. The rules have changed for 2020, and that is you can use net operating losses in prior years. That is, years where deductions were higher than taxable income. You can now offset income in prior years with the losses from this year or future years, so that there can be refunds available to your business from prior years that you can get access to immediately. And if deductions exceed income this year, or you don't have anything to offset in prior years, you can offset future income indefinitely. It's a really large and significant change that the CARES Act made. It's something, there's nothing for you to do immediately except talk to your accountant right now. this should substantially affect your business's financial planning, because if you're looking at opening and revising prior tax years and bringing more money into your hands right now, it could potentially be a boon for your business this year. The next thing I'm going to cover here are the corporate unused AMT credits. Nothing much to say here. If you're a C corporate, if you're organized as a C corporation, if you had unused AMT credits from prior years, you can accelerate all of those immediately into 2020, something that was not possible before the CARES Act. And finally, for business interest expense deductions, it's just the CARES Act raised the limits on the deductibility of business interest expenses from 30% to 50% of AGI for tax year 2020. So again, this could potentially ultimately provide a much bigger deduction for businesses that expect to have reduced taxable income in 2020. So all of these things, the net operating losses, the credits, the corporate unused AMT credits, and the expense deductions, there are a handful of ways that the legislature has tried to put money into your hands immediately to save your businesses, to make a more optimistic outlook for your financial planning for that business. Because again, you're going to be able to look into prior years where you had sizable taxable income, or future years where you have sizable taxable income, offset those losses, the losses that you make this year from those years. So you could potentially create a lot of additional opportunity taking advantage of those different tax changes. Again, my mantra here for this segment is talk to your accountant. Advance to the next slide, please. Deferral of employer share of Social Security taxes. James talked a little bit about that, but the only thing I'll add to that is, if you're still paying your employer share of Social Security taxes, talk to your accountant, because you almost certainly do not have to. If you're making monthly or bi-monthly or weekly deposits to account for your employer's share of those taxes, you don't have to do that for the remainder of 2020. You can defer that, as James said, into half in 2020 at the end of 2021, and the other half at the end of 2022. So, and tax deferral, time value of money is crucial here. You do not have to submit those taxes. You can use those funds that you'd otherwise pay for those Social Security taxes, your employer's share, for something else. The other needs that your businesses are in need of right now, you can apply those funds elsewhere, worry about paying those taxes in another year. That's the sort of, I'll sum up there and wrap up with the first portion there, which is just, again, a mantra here: talk to your accountant. Take these slides and talk to them. Are we deferring the employer share of Social Security tax? Do we have any net operating losses? Are we organized as a C Corp? Do we have unused AMT credits? Talk to them about those things, because again, once you sit down with your team of advisors and figure out your financial plan, it may look much more optimistic than you anticipate. And as I've sat down with clients over the past couple of months and worked through some of these things, they're really pleased to see that actually they're going to have much more money coming in, or they'll get refunds from prior tax years, or they feel a little bit more secure about the losses they're incurring this year, because they'll be able to offset those indefinitely in future years. So again, talk to your accountant. The final piece I have here is not a CARES Act related subject matter, but it's about estate planning. And as I mentioned, I'm an estate planning attorney by background. That's what I do at UBS almost all day, every day. And so it's incumbent on me, I think, to discuss this historic time in estate planning. And there are some reasons, but the first thing is, and from the prior slide that you don't have to go back to, is just getting your basic affairs in order. This pandemic, at least for most people I've talked to, for myself and my family included, it's put mortality on our minds, and on all of our clients' minds, on all of our minds. And what if we're the one, or maybe some of you have had family members who have either been affected by COVID, or been put on a ventilator, or become incapacitated, or unfortunately died. Having your affairs in order, and that means a will, a healthcare proxy, a living will, and a power of attorney, those basic documents, those are basic estate planning documents. It's a crucial time to do it while you're thinking about your mortality, while you're thinking about, well, what would I want if I were the one on the ventilator, or what would my family want? What kind of decisions would I want them to make about my healthcare? This is the time to be having those conversations, those challenging, difficult conversations. I know they're hard to have, but now is the time to do it, and to codify your wishes in the documents. So your will is going to be a place where you dispose of your property, right? But it's also the place, importantly, and most people don't know this, that it's a place where you name guardians of your minor children in the event that both you and your spouse pass away. And so a will in many states is one of the only places that you can name those guardians. So getting that in line and putting yourself at ease that if something did happen, things would be clarified and simpler for your family is crucial. A healthcare proxy and living will. Healthcare proxies where you name an agent to make healthcare decisions in the event that you become incapacitated. And that's going to be an important person, right? Someone you name, a spouse, a child, a friend, a guardian of some sort, where you entrust them to make those challenging healthcare decisions, the pull the plug or not decisions that are often the most challenging if you do become incapacitated at any point. The living will is a place where you codify what those wishes are. Do you want to be put on life support? Do you want, if you're in a persistent vegetative state, do you want life support? Do you want pain reduction? Do you want a DNR? Those kinds of things where you codify those wishes. And then a power of attorney is where you name an agent to make financial decisions for you in the event that you become incapacitated. Again, this is someone where you want your bills to continue being paid. Is your business in the middle of a sale? You want someone to continue all of those transactions, even if you do become incapacitated or if something happens to you. So getting those basic documents in order, I can't stress enough, it's a unusually favorable time just to be thinking about it. It's on our minds. Think about it. Get it done. If you already have it done, look through them again. The beneficiary designations on your insurance plans, your retirement accounts, make sure that they align with your wishes, that the people you named years ago, if you did it, are still the people you want to take that property at the time, or the people that you named to make those important decisions for you. Now's the time to do it. And the final thing I'm going to say here, before I turn it back over to Joe in a couple minutes, is that there has never, I've been saying this, and I said it before, there's never been a better time in estate planning history, in the history of estate planning, to do than right now. And I'll just mention briefly here that it's sort of the perfect trifecta of an environment. Gift and estate tax values, that amount that you can pass gift free of tax, gift tax or estate tax, that amount is at an all-time high. And it is set to, if Democrats come into power, which is sort of looking increasingly likely, at least in the last couple of months, definitely since before COVID, they have their eyes set exactly on these exemption amounts. They want to cut them by 70%. So right now we have this moment in time where we know with certainty that we can plan with these enlarged amounts from the Tax Cuts and Jobs Act, and they might go away next year. And I often hear, well, could they really enact those tax laws retroactively? Yes, they can. And they've done it. Even if Congress doesn't get their act together until maybe August, September, November, October, November next year, they can say, oh yeah, we're lowering the gift and estate tax exemption, we're increasing the rates, we're maybe getting rid of the step up in basis, we're maybe instituting a wealth tax, any of those things. They can do that and apply them retroactively in the tax year, and there's nothing unconstitutional about it. There's nothing in current jurisprudence that prevents them from doing so. And then two more, and the perfect trifecta I mentioned, that's one, these gift and estate tax exemptions are at an all-time high, but two, asset values across many asset classes are depressed, and that's important and good in estate planning, because when you pass assets, when you gift them and transfer them, you want those values to be depressed so that you eat into less of that gift and estate tax exemption. So now is kind of the perfect opportunity to do it. A side note and a caveat there, also kind of a perfect time to consider a Roth conversion of your IRA if that's something you're willing to do while asset values are down. Finally, to round out that sort of perfect trifecta, as I've been calling it, interest rates are at an all-time low, historic lows. So for June, the midterm applicable federal rate is 0.43%. That means non-commercial loans, if you loan someone funds for between 3 and 9 years, the minimum interest rate you can charge is 0.43%. So much decrease from what a commercial lender might charge. So making loans to your family, making loans to trust for the benefit of your family, or a lot of the transactions that estate planners rely on these kinds of loans, which again are at historic lows, which means that it's more favorable time than ever to do this kind of planning. For June, the 75/20 rate is 0.6%. If any of you have heard of grantor retained annuity trust or charitable remainder trust, this rate is used for those. All it means is if your assets in this trust grow at a rate of greater than 0.6% for the next however long you put that transaction into place, if they grow at a rate greater than that, then you pass the excess appreciation onto your heirs or trust for the benefit of those heirs or whomever you choose, gift tax free. Free from estate tax, free from gift tax, out of your estate. It's never been that low. Never in the history of estate planning has it been that low. So again, I'm rounding this out, and you're probably saying to me, Brad, You're telling me to part with a significant amount of my wealth to take advantage of these estate planning laws right now when there's a global pandemic, the economy's kind of in turmoil right now, and there's civil and domestic unrest in the world. You want me to part with my wealth? Yes, I do, because there are strategies, there are ways that we can give you the sort of control and access that you want, that you might want, in passing either business interests or other assets to trust for the benefit of the families. There are sort of backdoor ways that you can access those again if you really decide, no, I really want those funds back, or I gave away too much. There are ways, there are solutions for all of those problems. So I encourage you, talk to your trust and estate lawyer, talk to your UBS financial advisor, talk to me, reach out to me. I'm happy to help with anything, because I can't express enough the importance of just what a historic moment in time this is right now for estate planning. So thank you all. I'm here if you have any questions. Thanks.
Brad, thank you. That was very insightful. You force us to think about our mortality. We have a lot of family-owned businesses, an example, and it is a perfect storm. And irregardless of what political party gets control, we just added a whole pile to our debt, and at some point in time, we're going to have to pay for it. And you can't cut your way out of that. You're going to have to increase taxes at some point for some reason. So it's great for sharing. Thank you so much. Let's turn our attention now. Let's turn our attention now to Dr. Brian Rose. Brian is the senior economist for the Americas for UBS. He's going to give us an overview of where UBS sees the world going, see the American economy going, and then we'll pick up this flurry of questions we got on PPP. So Brian, welcome. Looking forward to what you have to say.
Thanks, Joe. If we could turn to the first slide, I'll try to answer the question at the top, which is, how long will it take for GDP to get back to where it was before the pandemic hit us? I think that's the best way to think about the shape of the recovery. Now, say at the beginning that it's clear that the economy is starting to rebound. There's no doubt. Pretty much every indicator that we look at has improved over the last few weeks. And in my view, we're entering the most crucial period. So if the next few months go well, then the rest of the recovery should go smoothly. But if there are problems and the recovery stalls or some another downward leg, we could be looking at a very long time before GDP makes it back to where it was before the pandemic. And another important point is that a full recovery is going to require a vaccine. So in order to get back to business as usual, we need a vaccine. And at the end, I'll give three scenarios, depending on exactly when that vaccine becomes available. Okay, now on the next slide, there are two reasons for why the economy is starting to rebound. The first is very obvious. If you go back to March 19th, that's the date when California imposed stay-at-home orders. And within a very short period of time, almost the entire country was in lockdown. So not surprising that the economy slowed really sharply when everyone is forced to stay at home. But a few weeks ago, we started to ease those orders. Every state has eased their restrictions to at least some extent. There's pretty much no one left in lockdown, and that's helped the economy start to get going again. And if you go to the next slide, this is one example of people moving around. So what this shows is the number of air passengers passing through the TSA security checkpoints. And they tell us every day how many people went through security. So this is a very good reading nationwide of how many people flew on the airplane. And I think there are two important points here. One is that the line is trending up. So the number of people flying has risen. It's about 4 times higher than it was in the middle of April. But if you look at where we are compared to last year, we're still down 80%. And that's true of a lot of indicators. So moving in the right direction, but still way below normal. Okay, please go to the next slide. Now, the second reason the economy is recovering is because we've had very strong fiscal and monetary policy support. So the PPP loans that we've been talking about, clearly this has helped to boost the jobs. The government sent out almost $300 billion worth of checks to households, and most of that arrived in April. We also have the enhanced unemployment benefits, an extra $600 a week going to people getting unemployment. So all of that has pushed a huge amount of money into the economy, and really helped to stabilize things. It's allowed people to pay their rent, to pay their bills, to be able to, in some cases, pay down their credit cards, and from the business point of view, has encouraged businesses to keep more people on the payroll. Now, on the Fed side, they rapidly cut rates to zero. They've increased their balance sheet by around $3 trillion. And we actually had an FOMC meeting just a couple hours ago, Fed Chair Powell promising we're going to use all our tools to do whatever it takes, as long as it takes, to support the recovery. So the Fed is on board. They're basically promising that they won't raise rates until at least the end of 2022. So I think there's no question about strong monetary policy support, but there is some question about fiscal policy. So one of the perhaps negative side effects of the good data we've been having is that it's encouraging President Trump and some Republicans to think, well, we don't have to do much more because the economy is already starting to recover. So we just in the last couple of days, turns out that the next fiscal package will be delayed likely until the end of July, and it's also probably going to be smaller than we were looking at before. So you may know that the Democrats passed the HEROES Act, $3.5 trillion. They passed that through the House, but what we end up with is likely to be way smaller than that, probably under $1 trillion and not coming until the end of July. All right, turning to the next slide. So I think if you want to look at one thing that will determine how this recovery goes, it's the labor market. And as you probably know, we had a big surprise, the May payrolls increasing by 2.5 million. But again, this is one of those indicators where moving in the right direction, but way below where it was before the pandemic. And the reason this is so crucial is that if you think, you had 25 million people lose their jobs in March and April. If they can't get back to their old jobs soon, they're looking at, a not temporary layoff, but a permanent layoff. And if you're, out of a job for 6 months, and then your company says, sorry, we expected to rehire you, but we're just firing you, have a job to go back to, then it's going to be really hard for a full recovery in the labor market. And, the clock is ticking. We have 3 or 4 months to get people back. And if it goes beyond that, then again, all bets are off. And it could be a very, very long time to get back to full employment. Okay, and if we can go to the last slide. So in the conclusion, I talked at the beginning about, we need a vaccine. So in our base case, we have a vaccine widely available around a year from now. And in the interim, you have loads of uncertainty over the pandemic, over politics. All of that makes it more difficult for businesses to fully commit to hiring and investing. And in that case, we think full recovery is still at least 2 years away. Now, in the upside case, and this has been looking more likely recently, is that we could have a vaccine available soon. So that announcement could come maybe in September, and a lot of doses available by the end of the year. That lets us have a very quick return to business as usual. GDP should make it back to the pre-pandemic level by the end of 2021 at the latest. But there's also downside cases. So either we have political dysfunction, Congress can't pass another package, or you have a lot of violent protests slowing the economy, or you have a big second wave of COVID-19. So this is another negative possibility that this could derail the recovery, force us to go back into lockdown. If we have a big second wave, we're looking at a very, very difficult recovery because the temporary layoffs will become permanent, and it'll take years and years and years for people to finally get new jobs. Okay, with that, let me turn it back to Joe.
Brian, thank you. A question for you, because you and I talked about this before, and you'd mentioned the the jobs report and the positivity behind that and the surprise behind it. What are the next 2 or 3 things you're looking for to give some indication that we're going to continue this rise, or maybe we're going to hit a plateau?
Yeah, so really the key is going to be, do people go out and spend? Because as we've been talking about, there's a huge amount of uncertainty, very difficult for businesses to invest until they actually, or rehire for that matter, until they see the demand. So we need consumers to lead the way. When we poured a huge amount of money into the economy, savings rate was 33% in April. So people have some money saved up to spend, and that's the real question. Are they going to go out and spend it? If they do, businesses will react. They'll rehire faster. They'll also, start increasing investment again.
Well, great, Brian. Thank you so much for your insights. And again, all these comments recorded. You got a copy of the recording and stuff to share. So thank you very much. Let's bring back James Jack now. James, we have just had a tsunami of questions come in on this, and Ann Petrick, working in the background, has been tirelessly working to consolidate them and bring them all together. So we're going to turn to you to play answer man on this, and we'll go as long as we got questions. So let's start with number one. The new rules. Okay, let's do it. With the new rules on how you get access to more PP money, one, if the original loan amount will not cover payroll for 24 weeks. So we would need more money to carry payroll personnel for the extra 16 weeks?
Yeah, so this is something I addressed quickly in the beginning, is you don't get any more money. There's a slight caveat to that. I'll loop back, but and actually I think there was a question in the pre one that will answer for that. But you don't get any more. So you get 2.5 months of payroll, right, which is about 9 weeks or so of payroll, maybe a little bit more than that, when you account for what was previously the 75-25 rule. So now what they've done is, you still get the same 2.5 months. That's not changing. You just now have 24 weeks to spend it, right? So the problem that we were seeing with business owners was, how the hell am I going to spend 75% or 60% of this 2.5 months on payroll if I've already let people go and I only have 8 weeks? That's what this 24 weeks is trying to resolve. So the number doesn't change. You just get a lot more time to spend it. The problem is, though, I bet, is a lot of you on here will drain that money in 10 weeks, 14 weeks, something like that. And then you've got another, in the case of 14 weeks, you got another 10 weeks where you need to maintain payroll, or else you're going to get your forgiveness number chopped down every time if you let people go. That's the catch. That's the negative of this change. So if you've spent most of your money, if you spent all of your money in the 8 weeks, and you had this loan already approved, and you hit the 60% threshold, you may really want to just get this over with and use the 8-week calculation and be done with it. Related to that, about 8 weeks or 24 weeks, there was a question on the chat about when do I do this? How do I apply for it? Good question. We don't really know. But what we do know from the Flexibility Act is it's within 10 months. And then what you should also know is it's going to take a long time for you to get your number then. So it's within 10 months you need to apply, and then your lender has 60 days to make a decision, and then the SBA has 90 days to review that. So you could be, it could be not for another 2 years from now before people, if you wait the 24 weeks and all this other stuff. So, PPP is like a bad zit in a way. It keeps coming back. So that's hopefully those answer those two questions about the timing on it. And on getting the loan forgiven increase, or the loan amount increase. Sorry, Joe. If you are a person like an LLC or a partnership where you don't get W-2 wages, you get profit distribution, such as yourself as an owner, employee. They made change on May 5th. That you can actually include those distributions as payroll, and you can go back to your lender and seek an increase for that specific example if you're an owner, employee, or a partner or something like that, and you're getting a distribution rather than rather than a W-2 payroll. So that's the nuance there that I want to make sure people knew about. That if you haven't done it, talk to your lender.
Well, it seems consistent with the intent of the program, which was to buy a bridge until summertime or so, when we felt the economy would begin to return and you could keep people on and wouldn't have to go through that hard restart. And we're starting to see signs of that, as Brian said, but boy, should something slow or hit a plateau, it's going to be a long and dark fall. So, so let's step forward. There's still time to apply for PPP, correct?
By the end of the month, By the end of the month, you need to apply. So you might want to just give yourself a little bit of extra time and don't wait to the June 30th if that's what you plan to do.
Right. Okay. Because there's still money available, and
150 billion available.
okay.
Tons of money.
There's been more talk about more money coming into the system, but it seems if there's still money there, why would you ask for more money unless we get to a plateau or we get a dip come August or September?
Well, on that, Joe, Secretary Mnuchin testified today in front of Congress, actually, and they talked a little bit about the failure of EIDL, but the success of PPP and how there's still a bunch of money left. And I think the Secretary's view is it's better to let this program fade away. And if we do need something else, to come up with a newer version where it's cleaner and where we've learned a lot. We certainly have learned a ton from this. And so that, I think, this program will end on June 30th in terms of new applications. And if there is a new version of it for whatever reason in the fall, you'll see it then.
Well, hopefully we won't have to deal with that because we'll be working our way back into recovery. Okay. Is there a clarification yet on the tax impact of PPP loans? Right, that's come up. There's 1, 2, 3. There's half a dozen on this. So talk about the tax impact of PPP, please.
Great question. The answer is no. That's the short version. So just for everyone's background is the CARES Act says if you get any indebtedness forgiven, it doesn't count as income. And people were like, great, okay. The IRS about 3 or 4 weeks later said, you know what, that's all well and good, but what we're going to make it is any of the money that you've used to pay for payroll, interest expense, rent, utilities that would normally be deductible is now no longer deductible. So effectively circumventing the CARES Act rule, just using some minor language, that kind of pissed off both Republicans and Democrats in Congress. They really didn't like that. So we do think there's a bipartisan support for putting it back in. I was surprised it wasn't shown in the Flexibility Act. However, Marco Rubio has said that he does expect to do some changes in the next stimulus, phase 4, which so there will be some revisions there. I expect it will be done there. If not, remember, there's no urgency to this one. So they have really until the end of the year, technically, to make this change. So I do think it will be changed, that it will be, tax-free. But as of right now, it is, the indebtedness is tax-free, but you don't get to deduct. So basically, you're being taxed.
So once again, stay tuned. Work with your tax counselor because the rules are changing as we play the game.
Absolutely.
Okay, let's step into this next one because you mentioned EIDL. How does the PPP and the EIDL interact and affect each other? Can you refinance an EIDL loan distributed after 4.3? So the whole interaction between EIDL, PPP, you mentioned PPP is going to go away, EIDL will remain. Clarification,
So the EIDL, I think there's a lot of mystery on this one because the program has not done well. They've been totally backlogged, and that's why PPP goes through these other lenders. And even though it goes up to 2 million, I think what they said on the testimony today is that they've been capping people at 150,000. Here's the deal. So if you've gotten a grant, that first emergency grant, that say up to $10,000, they're going to take that $10,000 out of your forgiveness. So let's just say, as an example, you have $100,000 in PPP and you spent $100,000, and so that's what you're trying to get forgiven. But you happen to also get $10,000. As I understand it right now, and there might be more clarity, is they're going to say, great, we're forgiving $90,000 because we already gave you 10, and then you owe us $10,000 over your 2-year term at 1%.
So just to clarify real quick. So I have a PPP and I have an EIDL.
Yeah.
Because if I got the 10K with the EIDL, that comes out of PPP because you already gave me 10 grand.
Yeah, exactly. Okay. So that's what they're going to say there. Part 2 of that is, so on how they interact is you're not supposed to use them for the same purposes. How they actually police that, I think, will be difficult. But that is something. And then about potentially, refinancing from an EIDL to a PPP. I think so. You can refinance if that loan was approved before February 15th. So I don't think any of the current EIDLs would be counted in that, since it would be well past February 15th if that loan happened. So you wouldn't be able to refinance that from a 3.75% to a 1% loan. Hopefully that answers that question. to my knowledge at least.
Okay. Next one, we're going to go deep in some of the details on the 60% of payroll costs. A lot of questions. All right. So stay with me on this one. Is the 15,384, that's 10K at 8 weeks.
It's now 46,000.
Down 46. Answer that question. Can companies use 401K and other incentive payments for both employees less than 100K and those over to maximize forgiveness? So how does a 401K play?
So just on the last one, yeah, divide 100,000 divided by 52 and then multiply by 24, you'll get 46,000, whatever it is.
Right.
So yes, that's great for sole proprietors and stuff like that. Particularly, it gives you some more capacity, and owners as well. Part two on the 401k. 401k, retirement contributions, healthcare insurance benefits, those do not count towards the $100,000 annualized number. So they're separate. It's only wages, commissions, which also includes like the hazard pay and bonuses that I mentioned earlier. So a 401k contribution or a healthcare, those are above and beyond the 100k annualized number.
Okay. You might have answered, if your annual health care insurance premium is paid during the cover period, is that entire amount eligible for loan forgiveness?
Yeah, so on payroll costs, as it's written right now, and there may be some changes to this, is payroll costs need to be both incurred during and paid during the covered period. Rent and utilities can be paid, could be incurred during or paid during. So there's a bit more flexibility on rent and utilities. But on payroll, it's got to be both. So you can't effectively look backwards. So that actually opens up a question about, like, sometimes a profit sharing contribution happens, this year, but it's for last year.
Right.
There's a chance that might not count. But on the other hand, it's fairly standard it's not like you're cheating the government there, which is I think what they were trying to prevent. So there's potential that they were going to come out with some more guidance, but now maybe with the 24-week extension, that's less of a concern for them. Yes, it's paid and incurred during the period for payroll.
Okay. You mentioned bonuses count. I bonus my team every 6 months since the bonus is paid on the previous 6 months. I just paid the bonus to my team. Is this covered as a forgivable payroll expense?
It should be. I mean, if it was in the covered period, then it should be. And then the fact that you've been doing it shows that this is a bona fide expense that you've been doing. I think that just helps with ultimately your lenders who chooses, but overflow them with evidence on it, and it should count. Yes.
Are payroll processing fees part of the forgivable costs?
I don't think so. So I think of a payroll processing fee as an operational expense, but I haven't seen anything specifically that says one way or the other. But just my guess is I don't consider that to be a payroll expense.
Okay, back to the bonus question. What about commissions for sales, or prepaid commissions, or draw versus commission? How does that fit together?
Same. So commissions are included in the wages. They're subject to the $100,000. Question I get a lot is, well, I was paying that person $100,000 last year because they were selling. They're not selling anything now, so now they're not getting paid. And effectively, you got to give them the outflow to get them back to that number, or you could potentially be impacted by that 25% number. So you got to get them to at least 75%. You're effectively paying them for nothing in that scenario.
Okay. James, we are flat out of time. We are right up against the top of the hour.
A little lightning round right there, Joe.
Well, it is. And I've got 5 more pages of questions. So we're going to consolidate that and figure out how to get those questions answered and back to the community.
If there's some common ones, Joe, happy to take some of them and write some answers out, and then you can share with the users if there's a few key ones that you want to share.
James, thank you so much. I really appreciate your expertise. Brad and Brian as well, your insights were so powerful. We really appreciate your time and attention. So with that, let's go to our last chart. And I want to again thank James, Brad, and Brian for sharing your insights. Everyone will get a copy of the recording and the presentation tomorrow. We'll get that out to you. And I invite you to join us this Friday as we discuss returning to the workplace with purpose, formulate a plan to navigate from regulations to the human element of recovery. Again, I remind you, you can find all of our content on funding at the Coronavirus Resource Center. And always to register for our webinars, those that you've missed, those that are coming up, you can register at vistage.com/webinar. That's vistage.com/webinar. I'm Joe Galvin, Chief Research Officer with VISTAGE. I thank you for your time and attention and look forward to bringing more great insights to you in the Leading Through Challenging Times series. Thank you and have a great day.